If you're a business owner and you're not using an S corp, you might be overpaying the IRS big time. What I'm covering today is I want you to know what an S corp is. I want you to know the advantages of an S corp, the disadvantages of an S corp, who should consider an S corp, who should avoid an S corp, and ultimately how to set up an S corp. So, what is an S corp? Ultimately, an S corp is a tax election. It's not a business structure. Your business must be an LLC or a C corp first to be able to make it an S corp. It's also a pass-through taxation. What that means is the profits or losses will pass through to the shareholders. You're you're avoiding double taxation because you're not a C corp in this, but the S corp also is not paying taxes. It comes through on a K-1. You put the K-1 on your personal tax return, and then if you have income, you're gonna have to pay on the income, and if you have losses, it will go against if you have active income like W-2 income. So ultimately, the last thing you need to know about an S corp is that it's limited to 100 shareholders, all of whom must be a US citizen or resident. Okay, so now that we know what an S corp is, what are the advantages of an S corp? The advantages are its tax savings on self-employment taxes. If you're a W-2 earner, you know that you have 7.65% of Social Security and Medicare taxes taken out of your paycheck that gets paid into the government. And then the other half, that 7.65%, gets paid by the employer's portion. Um, if you are self-employed, you have to pay self-employment taxes, the whole 15.3% on your profits. So if you make $100,000 in profits, let's just run these numbers. Say your business makes 300,000 for the year, you have $200,000 worth of expenses, you have $100,000 left over as a net profit. $100,000 times 15.3% is 15,300. I should have been able to do that on my own. But so that's just in Social Security and Medicare taxes. You have to pay that taxes on it. And then that $100,000 gets added to your income. So you also have to pay federal taxes on that. And depending on if you're married or if you have W-2 income someplace else, that $100,000 will go into the tax bracket that you're in, which could be 10, 12, 24% and on up. So those are the two types of taxes that you have to pay when you have a business and you're not an S corp. You have to pay that whole self-employment tax of 15.3%. However, if, for example, the same scenario, you have $100,000 in net profits that you would normally have to pay that 15.3%, which was like $15,300. Now you would go ahead and take a W-2. So your W-2, say you pay yourself $50,000, now you're paying 15.3% only on that. And that's $7,650. And again, that's an expense. Half of that would be an expense you would run through the business and be able to deduct that. So you're ultimately saving a good $7,650 in self-employment taxes. So that's huge. For instance, I was working with a client at the beginning of the year, end of last year, and I worked with several clients, and we did year-end last minute conversions and ran them payroll at the end of the year, saved clients tens of thousands of dollars, each of them with this conversion because they weren't just making 100, it was way over 100,000 that they were having to pay self-employment taxes on. And of course, we implemented other strategies too to save them even more money. But this one in particular, met with him again yesterday, and his main goal is he wanted to be able to start paying himself for that he could have a solo 401k because everything's paid off and he wants to start putting all this money into his retirement. Yesterday, I met with him again and ran the numbers again. For this year, if it goes as planned, as he wants to, we're going to save him $16,815 in self-employment taxes. And then with that savings, instead of paying that to the IRS, now he's putting that money into his solo 401k. So we'll be able to put away $29,500 into a solo 401k this year, and we'll be able to start doing that and continue that. And the savings is not just a 1 year thing. It keeps on going every year after another. And if he keeps on having the same years over and over again, 29,500 every single year is really going to start adding up quick for him. So that was his main goal, getting more money into retirement. All right. Another advantage of a S Corp is it's pass-through taxation. There's no corporate income tax. Profits and losses go to the owner's personal tax return. Right now, if you are a C Corp, not an S Corp, a C Corp, you pay 21% on whatever your net profit is. That's what the no corporate income tax means. Like you're not paying a flat 21% on the profits that go to the IRS for taxes. And then it also helps avoid the double taxation that happens in a C Corp. Some other advantages, it's liability protection. Owners are not personally liable for business debts or lawsuits, assuming they are in compliance and they're keeping up with proper compliance. That's what the LLC part of it is for. You have that LLC for the limited liability for the owner. But again, if you pierce that corporate veil or you're not holding up proper minutes and everything, I'll talk about that in a little bit, it kind of avoids the liability if you get sued. All right. So there's also, say you want to sell your business. It will make it easier to transfer the ownership of the S Corp. And this isn't compared to like if you only have an LLC. The ownership interest can be sold or transferred more easily with an S Corp. So that's another thing to keep in mind. If you're thinking about exiting, which I always tell my clients, think about the end in mind. Even when you start a business, I want you to be exit planning to know what you're going to do with this business and when you're going to get rid of it and what you want to do for that. And if you want to catch that video, I did selling your business a few weeks ago. And so you can go back and watch that one if you need help on that. Another advantage of an S Corp is credibility and professionalism. Like some businesses prefer an S Corp over an LLC for the perceived legitimacy in the eyes of lenders, clients, and investors. Okay, so we just got done talking about all the advantages of a S Corp. What are the disadvantages? I need you to know what the disadvantages are too, because I actually see a lot of clients come to me with S Corps, and I'm like, what are you doing? Why do you have an S Corp? So it's only right for certain people. So just for there's stricter rules and requirements with an S Corp. So you must file a Form 2553 with the IRS and elect an S Corp status. You must have a board of directors, regular meetings, and document minutes. And there's just a lot more paperwork than a standard LLC. And like I said before, if you are not keeping up with the compliance, which is the second bullet point here, if you're not keeping up with that compliance, kind of voids it. I don't want to say it voids it completely, but like if you were to get sued, if you don't have this stuff in place, like it's not going to have that limited liability that you're looking for. And there's some things that you can actually do to get the IRS to be like, we're revoking your S Corp status, which isn't great either. And once you do elect to have an S Corp, you have to stay with it for 5 years. It's a 5 year commitment, just for you know. Okay. Another disadvantage of an S Corp is reasonable salary. So the IRS, I guess you can say, knows this game, and they don't want someone in that same scenario, say 100,000 net profit, and then the person only takes like a 10,000 or $20,000 W-2 and takes the rest in draws, right? They want to make sure that you are paying enough into Social Security and Medicare that is reasonable for whatever you are doing, for that you're just paying the right amount. And my job is to make sure that you're not overpaying or underpaying self-employment. I actually have a tool, it's called Reasonable Comp, we can put in, and I want to make sure if we have that report, which we can do for you, we're going to put in all the hats that the business owner wears. And what I mean, like, you might be taking out the trash, you might be answering the phone, you might have to do inventory or, running errands. So you might, like, you should be that professional in your industry, but that's maybe 20% of your time or 50% of your time. You might be doing, say, 50% of your time doing other lower level jobs that we just face and we have to do it sometimes. Have to do marketing and sales and stuff like that. And that might be at a lower wage than what your primary um, job is. So we're going to take that into account. We're going to, work together and figure out what percentage of hours and how skilled you are at those jobs to be able to figure out what your reasonable wage is, and we'll have that and it'll be documented. And then the IRS cannot come back at us. Like, as long as we have that document, the IRS can't come back and be like, oh, but your salary is too low. And then the IRS will reclassify those distributions as wages and go back and charge you taxes and penalties. And that's not good. Like, sometimes those penalties and interest are actually more than the taxes that you pay if we just would have done it right the first time. So that is a tool that we have. We have a reasonable comp tool that we're going to use to make sure that you're not paying too much or paying too little. W-2, I want to make sure it's just right. For that, it will stand up if the IRS comes knocking on the door, because I don't want you to be paying more of that 15.3% self-employment taxes than you need to. But that is ultimately a disadvantage, is that reasonable salary requirement. Another disadvantage is the shareholders and ownership restrictions. Again, it's limited to 100 shareholders. There can be no corporations, partnerships, or non-residents. Um, so just so you know that. And then you can only issue one class of stock, limited investment flexibility. So like with C corporations, you can have A class and B class of stock. With S corps, it's only one type of stock and you can't deviate from that. Another disadvantage is S corps are at a federal level. They're not at the state level. The LLC is at a state level. So you have to take into consideration some state level taxation. You'll have to look into which state you're living in and if there's anything extra that you need to be paying for. So some states don't recognize S corps and tax them like a C corp. So remember I said like 21% on a federal level. I don't know what the state level is, and that would be something we'd have to look up. But for example, California imposes a 1.5% tax on S Corp's net income. So that's an extra tax that you may not be aware about, and it's at the state level. You get these tax benefits of the 15.3% in self-employment taxes, but there are some additional payroll and compliance costs that you will have as an S Corp. So just so you know, the owners must run payroll. Well, payroll can cost a couple of $1,000s a year, depending on how often you're going to pay yourself. If you have other employees, it might be cheaper if you're the only person and you're cutting yourself like a quarterly check. But you're going to have to file payroll tax returns, so those are quarterly, and then you're going to have to issue W-2s at the end of the year. So that compliance cost will cost you a little bit, and then you will need to have bookkeeping, like you need to stop doing it yourself. Like, you need to stop doing it on Excel or having just your shoebox like you've been doing like before. If this is you, I'm talking to you. So you'll need to get yourself some bookkeeping. So it'll be more expensive to have accounting and compliance compared to sole proprietorship or an LLC. And also another thing, you need to have bookkeeping, but you're going to have another tax return. You're going to have, instead of just doing that Schedule C on your 1040, your personal 1040 tax return, now you are going to have another tax return. You're going to have an 1120S, and those are normally more expensive, maybe $1,250 or so, give or take, depending on where you go. That's probably the average cost, though, to be able to do this tax return. And then the number of K1s, depending on how many people you have those K1s. And then if you have a K1 for yourself, it will flow through to your personal tax return. And then you'll have to put that K1 into your tax return instead of that Schedule C or whoever's doing your tax return. So who should consider an S Corp? Business owners that are earning $40,000 or more in net income. And the reason why I say net income, and this is, if you have partners, it's per partner. $40,000 is kind of the break even, like that, like the amount of money that you'll be saving taxes, but then the extra compliance, with payroll, accounting, and the tax returns and stuff like that. That's where the break even is as long as you're making at least 40,000 or more in net profit per partner, it'll be worth your while. The tax savings will be more than the expense of doing the S corp. Also, if you do not need to have any outside investors beyond individuals, this would be a good option for you. And then service-based businesses are also, they make S corps are really good for them, like consultants, real estate agents, accountants, like the service-based normally the net profit is a lot higher because like the cost of goods sold is lower. So those make good S corps. So who should avoid an S corp then? If you're a side hustler, you have a side hustle and you're making less than $40,000 in profit, the the extra expenses won't outweigh the tax savings. But once you're getting above 40 grand, that's when we're like, now it's the time. If your business needs any investors like C Corps, a C Corp would be more flexible to being able to have investors. Because remember, we can't have like other businesses invest in the company. And sometimes if you have a company, you want your business to be able to invest. So just know that if you need investors, probably should not go to the S Corp route. And then if you're an owner and you're wanting to have full business deductions with your fringe benefits, a C Corp would be a better option for you. All right. And then last is how to set up an S Corp. So the number one thing that you have to have in order to set up an S Corp is you have to have an LLC or a C Corp already. If you don't have the LLC is the first step. Okay. Then the next step is you need to file the form 2553 with the IRS. You have to have every single shareholder sign off on it because they need to know that they're going to have a pass-through taxation down to them. So they all need to sign that form. They need to save it, and then you'll need to send it in with the tax return. Also, in addition to sending it in immediately. And then you need to set up payroll and an accounting system. Like you need to get that bookkeeping done. Like it's just a must. Like if you're going to have an S corp, you need to have bookkeeping, you need to have payroll. And then you need to maintain corporate minutes, corporate compliance. That means having meetings, getting the minutes done, signing off on them. You need to treat this like the business that it is. So now that you know the pros and cons of an S corp, the big question is this the right move for you? Every business is different, and making the wrong choice could cost you thousands of dollars. If you want an expert guidance, let's chat. Go ahead and book a discovery call using the link below, and let's make sure that we're saving you as much money as possible on your taxes. Also, if you found this video helpful, don't forget to like and subscribe, hit that notification bell so you never miss a tax savings tip. Put your comments below. And if you have other ideas of topics that you want to talk about, go ahead and put them in the comments below. I'll see you for our next video. And what I'm going to do next week, I actually have a special guest speaker who's going to come. I'm going to do an interview style, and we're going to talk about your health. Your health as a business owner is so important because if you don't have your health, you don't have anything. And a lot of times entrepreneurs get so busy they forget to take care of themselves. And guess what? Sometimes, like, if your business isn't built up enough yet that it can't run without you and you get sick or you have to take a lot of time off, the business is going to start going downhill, and that's your main source of revenue, right? So, I want to talk to my entrepreneurs about how important health is and what are some things that you can be doing. All right, thank you. See you next time.